Sole proprietorship. A sole proprietorship is the simplest form of business, owned and run by one person. There is no legal separation between the owner and the business, which means the owner keeps all profits, but is also personally responsible for any debts or losses. It is easy to start and commonly used by freelancers, small shop owners, and independent contractors. Now, partnership. A partnership is a business owned by two or more people who share responsibilities, profits, and liabilities. There are different forms, like general partnerships where all partners are equally responsible, and limited partnerships where some partners have limited liability. It is often used for professional services like law firms or small businesses run by multiple founders. Limited liability company, LLC. An LLC combines features of both corporations and partnerships. Owners, called members, have limited liability, meaning their personal assets are protected from business debts. It also offers flexibility in management and taxation, making it a popular choice for small to medium-sized businesses. Corporation, C Corp. A C corporation is a separate legal entity from its owners, meaning it can own assets, enter contracts, and be sued independently. Shareholders have limited liability, but profits can be taxed twice, once at the corporate level and again when distributed as dividends. This structure is common for large companies and those seeking investors. S corporation, S corp. An S corporation is a special type of corporation that allows profits to pass directly to shareholders without being taxed at the corporate level. This avoids double taxation while still providing limited liability. However, it has stricter rules, such as limits on the number and type of shareholders. Cooperative, co-op. A cooperative is owned and operated by its members who use its services. Profits are shared among members, often based on their participation rather than investment. Co-ops are common in agriculture, retail, and housing, focusing on mutual benefit rather than maximizing profit. Franchise. A franchise is a business where an individual operates under the brand and system of an established company. The franchisee pays fees and follows set guidelines while benefiting from brand recognition and support. This model is widely used in fast food, retail, and service industries. Nonprofit organization. A nonprofit is created to serve a public or social cause rather than generate profit for owners. Any surplus income is reinvested into the organization's mission. Nonprofits often receive tax advantages and rely on donations, grants, and fundraising. Startup. A startup is a newly established business designed for rapid growth, often in technology or innovation-driven industries. Startups typically aim to scale quickly and may rely on venture capital funding. They carry high risk, but also the potential for significant rewards. Small business. A small business is independently owned and operated, typically with fewer employees and lower revenue than large corporations. These businesses serve local markets and include shops, restaurants, and service providers. They are the backbone of many economies. Multinational corporation. A multinational corporation operates in multiple countries with offices, factories, or services across borders. These companies manage global supply chains and markets, often having significant economic influence worldwide. E-commerce business. An e-commerce business operates primarily online, selling products or services through websites or digital platforms. It allows businesses to reach global customers with lower overhead costs compared to physical stores, and it continues to grow rapidly with digital technology.